Welcome to the Brighter Financial Blueprint podcast, where we will explore retirement and legacy strategies for affluent families and business owners seeking clarity, confidence, and intentional wealth design. I'm Megan Clark, RICP CEO, Clark Financial Solutions advisory firm, helping families create sustainable retirement strategies. Welcome back to the Brighter Financial Blueprint podcast. I'm Megan Clark, RICP CEO, Clark Financial Solutions. Looking forward to bringing value to you today in regards to speaking about charitable contributions on how they might fit into your blueprint. First, we'll get started and talk a little bit about charitably minded contributions and where they come from, where they go, and what purposes, they provide. So a lot of times our client families that we're working with, they are charitably minded. They are already contributing to different charities in their atmosphere, whether that be the church they attend or a charity because somebody's running a walk for it, or a different, organization that is near and dear to their heart. And so what a lot of times we'll talk to clients about is how it makes sense to contribute to those charities. If a client is over age 70 and a half, those donations to those charities should be originating directly from their IRA accounts and being sent directly to the charities. This is called a Qualified Charitable Distribution, or the acronym is QCD. The Qualified Charitable Distribution satisfies whatever mandatory withdrawal they have via the required minimum distribution, and it sends money directly from their IRA to the charity, and the charity receives that as a tax-free donation. One caveat to think about is that when you contribute to a charity this way, you no longer get to put that dollar amount on your tax return as a deductible donation. And the reason being is because you didn't pay taxes on it. When the money comes out of the IRA and goes directly to the charity, that withdrawal from the IRA is not actually taxable to you. So you're able to still support the charities that you'd like. However, we're lowering your taxable income by reducing the amount of required minimum distribution that you have to take out of your IRA each year. So qualified charitable distributions are something that every charity should be talking about, and every client over age 70 and a half should be using if they're making any charitable donations. So a really good one to keep in mind for yourself, your parents, your grandparents, whoever it's applicable to. Now, we'll step forward to the next idea. The next idea is the donor advised fund versus the foundation. So what is a family foundation and how can it support your initiatives and your goals versus what is a donor advised fund? So in a donor advised fund, you make a contribution to that donor advised fund. It's managed by an outside third party, and the directed donations that occur within the donor advised fund are a little more strict. Sometimes you can have some say over the direction of those donations, and sometimes you cannot. However, when we're talking to our ultra high net worth families, most of the time we're speaking to them about a family foundation. Why? What does a family foundation do that a DAF fund or DAF fund does not? And what does that family foundation provide to the family? Well, the family foundation is a great way to set up generational wealth transfer. There's this little saying in generational wealth transfer, and it can be a little crude, but it goes like this. The first generation makes it, the second generation enjoys it, and the third generation destroys it. Unfortunately, more often than not, what we see in generational wealth transfer is that the grandparents who made the money transfer the money down to the children. The children live a good life, but the grandchildren never witnessed the blood, sweat, and tears that went into what it took to create that wealth by their grandparents. And so a lot of times they're not taught the same principles around managing and organizing their money and their life that their grandparents were utilizing. And so that's where this saying comes from. This is where the Family Foundation can serve as a wonderful tool. The Family Foundation gets set up and you direct money to it. Typically above $250,000 would be the donation into the Family Foundation to make the most amount of sense at a minimum. We have a lot of families that set it up with more. But then out of that money then gets managed by the family as to what charities it gets directed towards, etc. And so this is a great place to teach money principles to the next generation. You can set them up with jobs inside the Family Foundation, researching different charities, and understanding the value of a dollar, which a lot of times is a principle that we don't really get taught anymore as things are on credit cards and swiping digital payment methods, etc. So understanding the principles of managing money can be a really great source for the Family Foundation to help the family with generational wealth transfer while still satisfying their charitable donations that they want to give throughout their lifetime. I want to tell a quick story about a donor advised fund that one of our clients set up for their family, because charitable contributions towards donor advised funds, family foundations, etc., they're definitely geared towards philanthropic initiatives. However, it can also be a great way to set up a legacy. We had one client who said, I want my grandchildren to always remember me. And so on the date of his birthday every year, a donation was made from the donor advised fund out to a charity of their choice, and their job was to pick a different charity every year. So it was a great legacy planning tool to just set up a great memory of their grandfather and pass that on for generations to come. Again, charitably minded organizations span different sectors, different industries. We're aligned here at Clark Financial with several. Our team loves to participate in the now called Blood Cancer United. It was the Leukemia and Lymphoma Society walk at the end of every year, and we raise funds and awareness through that. We also partner with a local charity, Cornerstones, through different initiatives helping the homeless population here in Northern Virginia. And then lastly, a different charity every year we partner with as an initiative here on a corporate level. So giving back is not just about the tax deductions. Giving back is not something that you need to feel like you have to do, but giving back is something that I know I feel called to do as a business owner, and being able to make an impact not only on our clients and our team members, our employees and their families, but also in the communities in which we serve. And it's something that I appreciate and love that our team is right there with me doing that. So more to come. Stay tuned for the next episode. We will be talking about a blueprint case study and how we created a blueprint with a family to get them to and through their retirement goals.